A stock can plummet rapidly when bad news strikes, prompting immediate concern over risk before full details emerge. Many investors instinctively retreat in these moments, as uncertainty often feels like a loss rather than an opportunity to reassess valuation. This reaction frequently occurs when temporary price fluctuations are confused with irreversible damage, alongside a lack of deep business insight. A wiser strategy is to differentiate between what is known and unknown, and evaluate the potential downside based on current price levels. Overlooking downside risk can wipe out years of savings with just one impulsive, overpriced investment made in excitement. By managing downside risk, maintaining patience becomes achievable, allowing rare opportunities for significant, long-term gains. Think about a small business in a disfavored industry where the negative headlines are loud, yet its assets might justify much of its valuation. Instead of merely predicting future outcomes, focus on creating a one-sided bet where mistakes won't lead to substantial losses. Throughout this video, you'll discover 9 filters designed to uncover low downside opportunities, determine bet sizes, and maintain discipline amid fear. This discussion draws inspiration from The Dhandho Investor by Mohnish Pabrai. Subscribe for more grounded approaches to investing. The term Dhandho emphasizes building wealth by minimizing risk while maximizing reward, crafting an inherently asymmetric benefit. The essential test is clear. The potential upside must be significant, while the downside should remain limited and manageable. Asymmetric investments safeguard capital, since a few small losses can be contained, while a single successful investment can lead to major gains. This strategy also helps minimize emotional misjudgments, as the approach inherently accounts for uncertainty without overcommitting to predictions. A motel purchased at liquidation value, funded conservatively, can weather tough times while owners gain operational experience and boost occupancy rates. Conversely, paying a premium for a flashy growth story creates no safety net during disappointing realities or when sentiments change. The goal is not to completely eliminate risk, but rather to seek situations where the odds are clearly in your favour. This advantageous tilt stems from factors like price, structure, and incentives, rather than attempting precise economic forecasts. A beneficial practice is to write out the expected downside in clear numbers, asking yourself what needs to happen for that downside to manifest. If the outcome relies on a convoluted sequence of hopes, it's best to bypass the investment and continue searching for simpler asymmetries. An existing business with a proven track record offers tangible data, making value assessments less reliant on speculation. Clarity is crucial. A business you can explain succinctly allows for better analysis of costs, pricing strategies, and associated risks. Your circle of competence refers to the businesses you fully grasp, including their revenue generation and potential pitfalls. Staying within this circle minimizes unexpected surprises, as fewer factors can derail your original investment thesis. A straightforward service business with stable demand can be valued based on earnings and assets, without the need for complex projections. A complicated financial structure may conceal risks hidden within contracts, revealing true exposure only when stress occurs. This methodology treats predictability as an asset, making it easier to assess and manage downside risks accurately. When the business model is well defined, uncertainty transfers from the business's viability to the price you're willing to pay. A practical exercise is to describe your business in 3 concise sentences, followed by identifying the 2 most critical variables. If you struggle to do this clearly, simplify your focus until the situation is straightforward enough for sound judgment. Risk refers to the possibility of enduring a permanent loss, while uncertainty involves incomplete information that can lead to price fluctuations. Opportunities arise when uncertainty peaks, especially when the potential downside is limited by strong assets, cash reserves, or consistent demand. A margin of safety means buying significantly below the conservative value, ensuring that errors in judgment still leave room for profit. The greater the discount you secure, the less reliant you become on being right about every detail, effectively reducing real risk. A distressed business might grab attention for its negative headlines, but a low purchase price can transform fear into a strategic advantage. Conversely, paying full price for a well-loved brand can backfire, as even minor disappointments may trigger substantial revaluations. This illustrates how low risk combined with high uncertainty can be a compelling opportunity, as markets often overreact to the unfamiliar. The aim is not comfort, but acquiring a price that has already factored in adverse possibilities while still maintaining a pathway to favourable outcomes. Begin by estimating a conservative value, then seek a meaningful discount before considering how much to invest or the timing of your purchase. If this perspective helps you navigate uncertainty more clearly, consider subscribing for more practical investing insights. Exceptional results often stem from a limited number of decisions, as only a select few opportunities provide truly favourable odds. The principle is to make few bets, but ensure they are substantial and infrequent, which means waiting for the right opportunities and acting decisively. Spreading capital across countless average ideas can weaken the impact of your best insights and increase monitoring demands unnecessarily. Focusing your investments becomes safer when each option has clear downside limits, as one misstep won't jeopardize your entire strategy. An investor who maintains a short watchlist can take swift action when fear drives prices significantly below conservative values. On the other hand, an investor who buys on a schedule might continue purchasing even when discounts are minimal and the odds are average. This strategy recognizes that inactivity can be a valuable skill, as most days are filled with noise rather than genuinely mispriced risk. When a rare bargain surfaces, the investor is already aware of the risks involved, the potential upside, and the rationale for taking action. Limit your research to businesses you can accurately value and document triggers for when the price becomes appealing. Then, size your position confidently, while also recognizing that often doing nothing is the optimal choice. Imitating a successful business model can be more prudent than trying to innovate, as the risks tied to execution are generally lower. Copycats analyze what works and replicate it with discipline, cost advantages, or localized knowledge. Innovators may pay the price of mistakes up front, while followers can reap the benefits of a refined strategy and steady demand from customers. This approach aligns with a focus on low-risk scenarios, as you leverage an established track record rather than gamble on untested inventions. For example, a family that acquires an underperforming motel and manages it more efficiently can succeed even without disrupting the industry. Arbitrage thinking seeks out similar inconsistencies where the price suggests catastrophe, yet the underlying economics remain robust. A strong competitive advantage, or moat, is essential for maintaining profits, whether through cost leadership, high switching costs, or established brand loyalty. When a moat is present and prices are favourable, the potential for profit increases significantly, while the risk diminishes. Focus on businesses where imitation is feasible, and then validate the moat with straightforward indicators, such as returns on capital. Pair this strategy with unique opportunities or undervalued assets, and resist the temptation to chase the latest trends when patience yields better results. The key shift is to view investing as a pursuit of asymmetric opportunities rather than a race of constant activity. When risk is limited and the price is advantageous, uncertainty transforms from a fear to a valuable tool. A solid understanding of business fundamentals, paired with durable moats and conservative value assessments, provides the foundation for safety in investing. You've seen how significant discounts, thoughtful timing, and focused investments can elevate a solid idea into an outstanding outcome. This approach minimizes the risk of irreversible mistakes, allowing for compounding growth without constant hindrances. It also fosters a sense of calm, as decisions are grounded in price, risk assessments, and evidence rather than the fluctuating moods of the market. Begin by compiling a short list of businesses that you can confidently articulate and outline what would classify each as a bargain. Next, exercise patience and await moments when uncertainty drives prices lower, always ensuring that the fundamental business aligns with your analysis. Over time, this disciplined approach will cultivate a portfolio built around carefully selected investments and many avoided pitfalls. To further enhance your ability to evaluate risk, price, and conviction effectively, subscribe and continue developing this critical skill.